Assalamualaikum and a very good morning. My name is Muhammad Shakir bin Razak.
My name is Nurul Adila binti Ramli.
My name is Dina Fatin binti Jasmine.
My name is Nur Asya binti Azliman.
My name is Nurul Izzah binti Muhammad Alimin.
Okay, today our group will present to all of you guys about the audit of the capital acquisition and repayment cycle. So we need to give the overview of this chapter and then what is going to happening in this chapter. So we just sort out all of the things in this chapter and we just give the summary. The student can understand really well what's happened in this subject. So we start with the first presenter, which is Asya. So Asya, go first.
Hello, my name is Nur Asya. Now I will present about the learning objective 1, about the identify the accounts and the unique characteristic of the capital acquisition and repayment cycles. Okay, next slide. Next is about the unique characteristic of the capital acquisitions. They have a few unique characteristics such as, first is relatively few transaction affect the account balance, but each transaction is often highly material in amount. Next is the exclusions of a single transaction could be material in itself. There is a legal relationship between the client entity and the holder of the stock or a bond or similar ownership documents. And last, there is a direct relationship between the interest and dividend accounts and debt and the equity. Okay, next slide is list of account in the cycle. Okay, first they have notes payable, contract payable, mortgage payable, bond payable, interest expenses, accrued interest, appropriates of return earning, treasury stock, dividend declare, and also they have next slide. And also they have cash in the bank, capital stock, common, capital stock preferred, paid in capital in excess of par, donated capital, return earning, dividend payable, proprietorship capital account, and the partnership of capital account. Okay, next slide. Next slide is about the methodology for the designing test of balance for notes payable. They have phase 1. Phase 1 is about the identify client business risk affecting note payable. The auditor study the client industry, external environment, and evaluate the management objective and business process to identify the significant client business risk that could affecting the notes payable. In the phase 2, they have a set tolerable misstatement and assess inherent risk for notes payable. The auditor will decide the primary judgments about the materiality for the entire financial statement. This allocation is called setting tolerable misstatement. Next, for the phase 1 is about assess the control risk for the notes payable. An auditor should identify factors that may increase risk, estimate the significance of the risk, assess the likelihood of the risk occurring, and determine the action necessary to manage the risk in designing the test of detail balance. Okay, for the phase 2 is about the designing and perform tests of control and substantive tests of transaction for capital acquisition and repayment cycles. In this phase 2, the auditor must perform the test of controls and substantive tests of transaction to study the effectiveness of the control. Okay, next slide is about the phase 3. Okay, in the phase 3, it have a designing and perform analytical procedure for the notes payable balance, and also for the designing test of detail of the notes payable to satisfy the balance related audit objective by using the audit procedure, sample size, item to select, and timing. Okay, that's all from me. Now I will pass to the next presenter, Nurul Izzah.
Thank you, Asya, for the splendid explanation. So my name is Nur Izzah binti Alimin, and I will be discussing on certain parts of design and perform audit tests of notes payables and related accounts and transactions. Okay. A note payable is a legal duty to a borrower that bears interest and may be unsecured or supported by cash. A note is usually issued for a period of 1 month to 1 year, but longer term notes are available. Securities, account receivables, inventories, and fixed assets are examples of assets for which notes are issued. The note's principal and interest payments must be made in compliance with the loan agreement terms. A principal and interest payment is normally expected only when the loan is due for short-term loans. The note for loans longer than 90 days are typically requires only monthly or quarterly interest payments. Okay, the accounts for note payables and related interest accounts are shown in the diagram in our presentation here. Okay, since principal and interest payments are recorded in the cash disbursements journal, auditors also include tests of principal and interest payments as part of the acquisition and payment cycle audit. Capital transactions, on the other hand, are rarely included in the auditor samples for tests of controls and substantive tests of transactions due to their rarity. As a result, testing these transactions as a part of the capital acquisition and repayment cycle is very common. Okay. The audit of notes payables mainly have three goals. First is to assess if internal controls over note payables are adequate. Second is in compliance with the 6 transaction-related audit objectives. Transactions for principal and interest involving notes payables are properly authorized and documented. So finally, 7 of the 8 balance target audit objectives require that the liability for notes payables as well as the related interest expense and accrued liability to be properly recorded. Okay. There are 4 major controls on notes payables. The first one is proper authorization for new note issuance. This can only be done by people who have been appointed. Okay, for example, both the loan agreements, which typically stipulate the amount of the loan, the interest rate and repayment terms, and the assets pledge, requires 2 signatures of properly authorized officials. As notes are renewed, they must go through the same authorization processes as when new notes are issued. Okay. Second is adequate controls over the repayment of principal and interest. The periodic payments of interest and principal should be subject to the controls in the acquisition and payment cycle. Okay, for example, at the time that the note was issued, the accounting department should have received a copy of the note, much like it receives vendors' invoices and receiving reports. The accounts payable department should automatically issue checks or electronic fund transfers for the notes when they become due. Again, in the same manner in which it prepares payments for acquisitions of goods and services. And then the note provides that the supporting documents are documentation for payment. Okay. The third point is to keep proper documents and records. This includes subsidiary records and a control over blank and paid notes. Paid notes should be cancelled and kept in the possession of an authorized person. Okay, lastly is periodic independent verification. Okay, for example, an employee who is not responsible for keeping the detailed notes should reconcile the detailed note records with the general ledger and compare them to the note holder's records on a regular basis. Simultaneously, an independent individual can recalculate the interest expense on notes to ensure that the tests are accurate. Okay. Tests of notes payable transaction involve the issue of notes and the repayment of principal and interest. These audits are partly of the controls and substantive tests of transactions for cash receipts and disbursements. Because of the importance of individual transactions, additional controls and substantive tests of transactions are often performed as part of tests of details of balances. So some of the recommendations to improve these are: first, control tests for notes payables and related interests should focus on the 4 internal controls that we have discussed earlier. And second, auditors can also double check the accuracy of receipts from note receipts as well as principal and interest payments. Okay, so that is all from me. For the next part of this learning objective, I will pass on to Shaki. Thank you.
So alright, so I will start with my parts, which is my name is Muhammad Shakir Brazak. So I will continue with the analytical procedure. So as we know, analytical procedure are essential for the notes payable because tests of the for interest expenses and accrued interest can often be eliminated when the result are the favorable. So they have the objective for the analytical procedure, which is number first is to help auditors evaluate and the reasonable of the interest expenses and also has been tested for the omit that's happened in the notes payable itself. Okay, next slide. So this is the analytical procedure for the notes payable. So for the test number one is we need the analytical procedure. So we need first is to recalculate the approximate interest expenses on the basis of the average interest rate and overall monthly notes payable. So the possible misstatement that we trigger from this one is the misstatement of the interest expenses and accrued interest or omission of the notes payables. Okay, next. Okay, and the next one is is number two is we compare. The legal procedure that we carry on is we compare the individual notes outstanding with those of the prior year. So the misstatement that we cannot is to compare the total balance in the not payable interest expenses and accrued interest with prior year balance. Okay, all right. So the possible misstatement is the omission for the misstatement of the not payable, and then omission misstatement of a not payable is for the compare for the total balance lah. For the compare for the individual notes outstanding, so we just need it's the same as always as a compare of the total balance. Okay, so next. So what is the major balance related audit objective in the not payable? Because there are two important balance related audit objective in not payable. Is number one is the completeness, which is the existing notes payable included. So we just give the completeness to the objective of the notes payable. Number two, if we get the note payables in the schedule are accurately recorded, so we know the audit objective will be accuracy. But because all the notes payable is being accurately recorded in the journalization in the journal, so accuracy will be the audit objective for this one. Okay, next. Okay, so this is a diagram how the types of audit tests for capital acquisition and repayment cycle that we have carried out. So as you know, this is an example of the XYZ company include for the notes payable. So as you know, they have their payee. Payee is always as we come for the notes payable. So the note payables is someone who we as a company that we own that's under the supplier, the money itself. So for the payee for the XYZ, the first one is the First National Bank, and the second one is the Second National Bank, and number third one is the Third National Bank. So as we know, they have their security, security and investment. So you can see the dates that the investment was made on the for the First National Bank is 13 September 2010. Okay, for they have the due and the face amount itself. Okay, for the description, what's type what's the payee is for the investment for our company. So they have the valuation and the balance for the beginning first. So we just need to calculate on. So this this is just the overview of the notes payable. Just the example lah for the XYZ notes payable. Okay, for next slide. Okay, for the notes payable, types of audit tasks for the notes payable that have been carried out. So like this is the notes and the interest. Okay. For this one, so I'll be sure I will just explain to you all guys. So we have the addition, payments, and balance of end year. So our company has made the payments of the 10 of the 100 of the 100 of the 10,000. Okay, so at the end balance is just the negative 01 because we have made the payments. Okay, so for the addition, it's we have the 10,000. So at the balance of the year period, so we just recorded the 10,000. And then addition, we have also the addition of 10,000. So balance of the end period will remain the same as the 10,000 because we don't have any payments for these things on. So we just need to calculate all of this one. So the notes, previous slide. Is that previous slide? For the 20,000, so we have the rate of the 9%. This rate is just given by the bank itself. And then we have the interest on for the accrued beginning of a year period. So these 230 just we just not recorded itself. So we need this has been classified as the accrued one. So we have the expenses of the 2712. So at this year, so we have the payment of the 950. Okay, so if you plus 238 plus with 712, so we get the 950. So we just made the payment of the 950. So accrue of the end period, so we will be give with 01 because we have the payments of and also we have the expenses. Okay, for the second year, as we have the expenses of the 250 for the year index, and then they doesn't have any payment for the year, so the accrued in end of the period, so we have the 250 because we don't have any payment for this year. And then for the next one is the expenses is a 1167. All right, so we don't have any payment, so the accrued end of the period, so we just brought forward 1767 to the forwards. Okay, so we just need to calculate all of the totals of the accrued of the end year period is we total up for the 417 for the year ended. Okay, next slide. So this is a balance related audit objective and test of detail balance for notes payable and interest. Okay, so we have the balance related for the audit objective, and we also have the common test of detail balance procedure for each of the objectives. For the number first is the notes payable. In the notes payable, I schedule agree with the client notes payable register or master file, and the total is correctly added and agree with the general ledger. As we know, the objective will be for the detail tie-in. For the common test of detail balance, so we have been carried out procedure is the first on put the notes payable list for an accrued interest not payable. So we need to put up all everything on not payable list, and then we need to trace all the totals and to the general ledger. So we need to check one by one in the general ledger, and then trace the individual notes payable to the master account. Okay, the number two is the notes payable is scheduled exist. So this means so they have the exist. So the objective will be the existent. All right. For the comments of the test of detail balance, CODB, is number first, we need to confirm first what is the not payables, okay, with the company. And then we need to examine the duplicate copies notes for the authorization. So we have the notes payable first, and then we have the duplicate one. So we need to check one by one as per the existence of the copies. And then we need to examine the corporate minutes for loan approval. Okay, next slide. Okay, for the balance related objective for the number three, I think so number three, right? Okay, is the existing note payable are included in the notes payable schedule. So as we know, the audit objective will be the completeness. So the common test of detail balance procedure, I think some. For the notes payable and accrued interest on the schedule are accurate. So we just know there has been the accuracy one. So we need first to examine notes paid after year end to determine whether they are liability or the liabilities at the balance sheet on. And number two is we need to obtain a standard bank confirmation that's included the specific reference to existence of the note payable from all the bank, which is the client does the business. So we just need all the accuracy one. So we just need to contact all the banks and make calls or just go to the bank to get it all the reference. So we just need what is the approval from the bank. So we just need to check one by one itself. And then we need to review the bank reconciliation for new notes credited directly to the bank account by the bank. So we have the bank statement first. Okay, we just need to sort out. We need to clarify. Okay, which one the amount is come from. So we know that the amount is for the new notes credited in the bank's account. All right. Next. Okay, that's all from me. So I will pass to the Adila for the next presenter.
Alright, thank you, Shaki. Now I will continue to learning objective 3. Identify the primary concern in the audit of honest equity transaction. Next slide. Alright, first of all, honest equity. There are two business in honest equity, which is public health corporation, known as public listed company, and closely held corporation, which is a private limited company or known as Sendirian Berhad. Three common things that are looking for in honest equity. First of all, capital and ordinary or preference shares. What is ordinary and preference shares? Ordinary shares have voting right in AGM. Dividends depends on community performance, company performance. If they perform well, they get more, while preference share didn't have the voting right, but they enjoy fixed amount of dividends. Whatever it is for dividend who got more, the company must pay the preference shareholder first. Secondly, paid in capital in excess of par, which is share premium. In Company Law 2016 stated there is no more share premium applicable after year 2016. Lastly, retained earnings and related dividends. Alright, some criteria in public health corporation. First, many shareholders. Second, frequent transaction. For closely held corporation, first, few shareholders, simple and few transaction, and occasional transaction. Next slide. Alright, this honest equity and dividend accounts. This figure showing honest equity and dividend accounts that provide an overview of the specific honest equity account that have been discussed. Alright, next slide. For the objective, first, internal control over capital share or related dividends are adequate. Second, honest equity transactions are correctly recorded as defined by the 6 transaction-related audit objective. And last, honest equity balances are properly recorded as defined by the 8 balance-related audit objective and properly presented and disclosed as defined by the 4 presentation and disclosure-related audit objective for honest equity account. Next slide. For internal control, there are several internal control are important for honest equity activities. Some of them, first and foremost, proper authorization of transaction for the issuance of capital share, repurchase of capital share, as well as declaration of dividend require board approval. All these 3 must have approval from board of directors. Number 2, proper record keeping and segregation of duties. Documents need to be maintained are capital share certificate report and shareholder capital share master file. Master file is an individual record for each shareholders. For example, let's say our client have 5 shareholders and they need to maintain separate records each shareholder. Number 3, independent registrar and share transfer agent. This one applicable for public listed company. Usually PLC will engage with independent registrar or share transfer agent For instance, in Malaysia, which famous Symphony House and Tricor, there are company secretaries and independent registrar maintain all the share certificate related transaction, especially for PLC. If let's say the client engage with an independent registrar that shows the good internal control because it is maintained by the party instead maintained by themselves. How to know who they engage? Usually, we as an auditor should send confirmation letter to a client asking about share-related transaction. All right, that's all from me. I will pass to the next presenter.
Mike. Mike.
Sorry. Next, I will continue. My name is Fatim Jasmine. So I continue learning objective 4. Design and perform tests of control substantive tests of transaction and test of detail of balance for capital stock and retail earnings. Next slide. So audit of capital stock and paid-in capital. First is completeness. Existing capital stock transaction are recorded. The auditor can confirm with them whether any capital stock transaction occur. Second, the accuracy of existing transactions. So next is occurrence and accuracy. Record capital stock transaction occur and are accurately recorded involving issuance of capital stock. The occurrence transaction related objective can ordinarily be tested by examining the minute of board of director meeting for proper authorizations. Next. Third is accuracy. So capital stock is accurately recorded. Auditor verify the ending balance in the capital stock account by first determining the number of share outstanding at the balance sheet date. Second, PV times number of share PV. So the ending balance in the capital in excess of per account in a residual amount is audited by referring the amount of recorded transaction during the year and adding them to or subtracting them from the beginning balance in the account. So last is presentation and disclosure. Capital stock is properly presented and disclosed. First, the most important source of information is corporate charter, the minute of board director meeting, the auditor analysis of capital stock. So next slide. Okay. So next is audit dividends. So all 6 transaction related audit objective for transaction are relevant for dividends. But typically dividend are audited on 100% basis. The most important objective including those concerning dividend payable are first, occurrence recorded dividend occurred. Second, completeness, existing dividend are recorded. Third, accuracy, dividend are accurately recorded. Fourth, occurrence, dividend are paid to stockholder the exits. Next, completeness, dividend payables are recorded. And last, accuracy, dividend payable are accurate recorded. So next. Okay, next is audit of returning earning. For most company, the only transaction involving return earning at the net earning for the year and dividend declared. So other change in return earning may include prior period earnings, prior period adjustment. Next, appropriation of return earnings. So next, there may be correction to prior period earnings, prior period adjustment, and appropriation of return earnings. So that's all from us. Thank you.
All right, sir, that's all from our group right now. So I hope you enjoy our presentation for this chapter, and I hope we are doing well. And thank you very much. Thank you very much, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.